Anybody involved in crypto needs to understand how you can get yield from these instruments, regardless of the price movement. And again, it's just more and more of a use case for everybody in the world getting into crypto and having a percentage of your assets in that, right? Again, we know people in Ukraine, and it's like, man, how much do you wish you would have had some stable coins? I always say, when did Noah build the ark? Before the storm.
Today, I really feel like this is such valuable information because we have the very low risk, the lowest of all risks, still with asymmetrical returns, especially with infrastructure play that have corrected and still provide double-digit yields for some of these proof-of-stake platforms. I feel like today, if I had to go through every single type of passive income form or opportunity, I think we've covered the most important.
Just push yourself to do this. And even if you think it's complicated, it's actually not. And once you do it once, you're like, oh my gosh.
To be honest, Brian, there's so many fundamental, positive, bullish news that are going on. I've never been so confident in my life, ever, ever, ever.
In this space.
In this space.
Yeah.
It's just so much innovation, and China banned still. You can't even buy or mine Bitcoin, one of the biggest economic forces in the world, and we still reached another all-time high. Like, there's so many use cases that are building across the world. I'm just super bullish.
Again, you have to take ownership of your finance. You know, financial freedom is the first freedom. You know, I think it's more important than any other freedom. If you don't have that, you can have freedom of speech, you can have freedom for elections. So like, get your money right. The world is changing. Inspiration is everywhere. It has never been so easy to connect, share, and bring people together. We're learning from others and finding the best in ourselves. Challenging our beliefs. Sharing our vulnerability. Overcoming our fears. Transforming ourselves so we can transform the world. How far can we go? This is London Real. I am Brian Rose. My guest today is... This is London Real. I am Brian Rose. My guest today is Alex Fazel, the cryptocurrency advocate, TEDx speaker, broadcaster, and blockchain educator. You are the Chief Partnership Officer of SwissBorg, a team of finance and technology experts dedicated to democratizing crypto wealth management by making it fun, fair, and community-centric. You're also the host of Kryptonites, the popular YouTube channel dedicated to blockchain and cryptocurrency education that's featured me as a guest and Alex Mashinsky, Dan Held, tons of others. SwissBorg is ranked as the top 5 largest DeFi liquidity providers with over 500,000 active community users. Last year, SwissBorg was awarded the Mass Adoption Project of the Year, the AI App of the Year, and named one of the top 100 Swiss fintech startups. Today, we're going to talk about how to make money in a crypto bear market via stablecoins, staking, passive income, generating yields. Alex, welcome back to London Real.
Feels like home, my friend. It feels like home.
Right? I mean, look, you hosted our 10-year anniversary. We had you on last time to talk about Polkadot parachain auctions. We went deep on Akala and Moonbeam and the 5 T's of evaluating protocols. So it feels like we've done this a lot, right?
I love the vibe here. This is really an amazing place. And I think we have the hottest topic of the moment. But before we start, Brian, can I ask you, what's going on with this fight? Is this real? Is this happening?
So first of all, Alex is right. We're going deep today on some really important staking protocols. We're going deep on stablecoin yields. So pay attention. But yeah, the fight, I haven't had a chance to talk about it, and maybe I'll just answer it because I haven't even told you much about it.
Yeah, I know.
So 1 month from today, I think, on April 2nd, on Saturday, at the O2 Arena in London, the actual O2 Arena, I'm going to go box my world boxing debut, and I'm going 3 rounds in the ring, and this is real. And it's weird that I'm making my boxing debut at the biggest indoor stadium in Britain, but it's happening. And so this is how it happened. A friend of mine named Martin Ford, who was on the show about 3 or 4 years ago, he's a hulk of a man, almost 400 pounds. He's a Hollywood actor. He's been in Fast and Furious, bodybuilder. He is headlining the card. and he's fighting the Iranian Hulk. They're both about 150 kgs. And it's a whole celebrity boxing night. They got a bunch of stars from Love Island. Patrice Evra, huge footballer, is going to be there. Big celebrities in the audience. And Martin called me up like the week of the David Icke live broadcast and said, Brian, you should fight. And I was like, Martin, what are you talking about, man? I'm 50 years old. And he said, Brian, he's like, I know you. And he said, I think you should do this. So at first I thought, this is ridiculous. I'm not going to do this. But, I trained martial arts for many years. I never really had a fight. And then I was like, you know what, Martin? I've learned one thing in London Real. You got to go into your fears. That's where all the growth is. That's where all the fun is. So, told my wife, she wasn't too impressed. And told my team, not too impressed. Told my trainer, who said, bad idea. And then I said, look, let's just do this. So it's on. I'll be making the walk and I'll be fighting. I'm excited, I'm terrified, I'm anxious, I'm stressed, I'm also pumped, and I've been training really hard. So that's what's happening. I've called out Sadiq Khan, the current mayor of London, because we went head to head for almost a full year when I ran for mayor. And honestly, he needs to be held accountable for this mess that he's turned this city into. So I asked him to show up. I think he's going to duck me, is what's going to happen. But we're waiting for him to reply. He's 50 as well. And, during the election time, he goes to the local boxing gym. He hits some pads. They all do, right? So I'm like, okay, you've pretended like you're a boxer. Why don't you just show up? And I said, actually, I might actually respect you if you make the walk. And I think people in London would too. So I'm waiting for him to actually show up in the ring. If he doesn't, then they're finding me an opponent. And we're going to do it, man. We're going to swing. So it's a little crazy, I probably should have done this when I was 40 or when I was 30, but I'm going to do it now when I'm 50. One final aside, I heard today that there's a YouTuber that might want some of this as well.
Oh, wow.
And so there's a YouTuber named Nico who ran against me for the mayor of London, 23 years old. And when I went to City Hall on May 8th for the vote count to be read, they put us all in one room. And Nico walked up to me with a bottle of piss in his hand, and he handed it to me and said, here, this is for you, Brian. Because there was an old video of me drinking my own urine.
Yeah.
And so Nico came up to me, and there at City Hall, I said, okay, thanks, Nico. I said, I appreciate that. I said, guess what? You and I should fight. And he was like, uh-oh, what do you mean, Brian? Because he had his camera crew there. And I was like, I don't know, for some reason I said, why don't you and I fight? I said, you're half my age, why don't we fight? And he got all quiet and kind of ran away. And somebody tweeted it that night, some journalist said, I heard that Brian Rose just challenged Nico to a boxing match. And that was like a year ago. So now I hear that, his crew has been, talking about this. So I'm calling out Nico to see if he actually wants to step up. Again, he's half my age. So we'll see. There's great charities involved. The Frank Bruno Foundation for Mental Health is being supported by this. Frank Bruno, the boxer, has been on my show. And I've had a ton of boxers that are helping me out behind the scenes. So that's what's happening. I think everyone is confused by this, including my family, but I'm going to do it. So yeah, what do you think? You've been in some fights
Confused, but London Real. It doesn't get more real than this, Brian. I mean, you're really laying it all out there for everyone to see, and every single challenge you've been offered, you've accepted them. So hats off to you for that.
Man, I just want to say for the record too, it's not like I do this in my spare time. It's not, this is as stressful and as it would be for anybody. And again, at my age. So yeah, you're right. This is kind of the ethos of London Real. Go into your fears, get comfortable being uncomfortable. So trust me, there's a lot of much better things I could be doing on a Saturday night in London, right? I'd probably be at home with my kids, but I'm going to make that goddamn walk, and I'm going to go into that ring, and whatever happens is going to happen. And look, there's a lot of people that want to see me punch Sadiq Khan in the face. But let's be honest, there's a lot of people that want to see Brian Rose get punched in the face. And guess what? You can have both on that night. And I don't know what's going to happen. And, 3 rounds is a lot. When you get to that 3rd round and, you're dead tired and those hands want to come down and you want to go home and you can't, that's when you get to find out what you're all about. So my old martial arts instructor, he said, Brian, you learn a lot about yourself when you get into a fight.
Yeah.
You learn to find out what you're really about. So I'm looking to find out. And then it's going to be on such a big stage that I don't know what that's going to feel like. I've attended UFC events at that same arena. I've watched Beyonce sing at that arena. I watched Dr. Jordan Peterson debate at the O2 Arena. I never thought I would be, the attraction at the arena.
That's amazing. I mean, you're getting out of your comfort zone, discomfort, and then the learning zone, as you mentioned. It's important for us to always navigate these opportunities, and huge respect. Really,
Thanks,
really,
man.
really.
And this whole thing, I'm too old to do something, or I'm too this to do something. I don't have the education. I don't have the finance. Like, I don't believe that narrative. So I'm trying to put my money where my mouth is. And look, my boys, my boys, we all hang out together and stuff. And are they old enough to understand this? No, but I'm hoping, 10 years from now, they'll know that, what we do in our family is we challenge ourselves. So.
And it's for a good cause.
Yeah, and it's for a great cause. And yeah, we're doing it to get attention to this whole thing. And I actually think combat is something that we need to embrace as individuals and humans, and even as men and young men. I think it's good for mental health too. So yeah, that's the plan, dude. There you go.
There you go.
All right, let's talk crypto. Let's talk what to do in this bear market, stablecoins. People don't know Alex Fazel is one of the smartest in the business when it comes to yield, all of the things we're going to talk about today. First of all, bear market. That's kind of why we're talking here. What's going on lately, and how should people react? Because most people freak out when coins are down.
Well, as you know, there's lots of turmoil in the world, and we're really in a very uncomfortable space with the wars going on and everything like that. But just to look at the brighter side, one thing that I've noticed is we've just validated an extra use case with regards to Bitcoin. We saw the prices recovering. Why? On-chain statistics are showing that the rubble is one of the primary reasons people going from rubble to Bitcoin, because they see their own national currency devaluating.
Right,
that's
the Russian
number
currency,
one,
which
right?
is going down. It's been, blocked economic sanctions, and people, you say, we can actually see on the blockchain that people are exchanging their rubles to get into something like Bitcoin.
Exactly. So it's not only that it's losing value, but also when the banks are being blocked, that's creating a huge use case. And same thing for the local currency in the Ukraine, right? The UAH has gone up 9-fold in the past few days in terms of people parking their money into Bitcoin. So once again, this is a huge use case that's showing that when there are wars, political conflict, Bitcoin is an anti-political statement.
Yeah, I totally agree. And I was telling my students the other day, I said, if you were a citizen of Ukraine, which now means if you're a citizen of Russia, how much would you rather have a MetaMask wallet with some stable coins and some, other, basically crypto that you could cross the border with?
Yeah.
You didn't have to worry about a banking institution or international sanctions or a currency like the ruble. Man, I mean, that could literally save your life right now, save your family. Don't get me started talking about Canada, where the Prime Minister is freezing people's bank accounts if you're involved in protests. There's a lot of recent use cases for crypto. Right?
It's been so bullish, right? And I think that right now, even though we have a bit of a recovery in this trend, we're still not in a bear market, right? We have QT coming down in H2. We have other factors that could hurt the current market and keep us sideways, even go back down into a bear market. So I think today's episode is going to be very, very valuable with a ton of actionable items.
Yeah, I agree. And before we get to the first slide, let's just talk about this. I mean, look, the choppiness in crypto, it's going to be here for a little while, right? Let's just be honest. It's not like it's going to pop back up. We've got potentially the Fed in the US going to raise rates. We've got all sorts of uncertainty going on with the world. Stock markets are coming off some days. So it's not like we're out of the clear.
Exactly.
So two things. Anybody involved in crypto needs to understand how you can get yield from these instruments regardless of the price movement. And again, it's just more and more of a use case for everybody in the world getting into crypto and having a percentage of your assets in that, right? Again, we know people in Ukraine, and it's like, man, how much do you wish you would have had some stable coins, on a MetaMask wallet or something, that you could move, have ownership over, cross borders with, get yield on. And then Russia, right? Who would have thought as a Russian citizen, your own currency would have been at risk, or even moving your money via SWIFT or something. I always say, when did Noah build the ark? Before the storm. So it's like, you got to be involved in this.
Exactly. And the whole value investing principles, from Graham's book, The Intelligent Investor, Warren Buffett is not good at selling the top. He actually never sells. He only rebalances. How did he make his money? The most important investor, most successful investor of all time is buying low, Brian. So it's in the bear markets that actually Warren Buffett is making all of his money, isn't it?
Yeah, it's that, and he holds long-term.
And he holds long-term,
long-term perspective, and he buys, things he believes in. He buys Coca-Cola. He buys Hanes underwear. You know, he buys things that he's like, people are always going to need and they're always going to use. Hello, these cryptos are staring us right in the face. Incredible use case scenarios, even in these times right now, which, you know, they're pretty turbulent. And like you said, these yields, we know that blockchain and crypto is like not only a change in technology, it's a shift in human paradigm. So
yeah, and because everyone can make money in a bull market, but the most intelligent make money regardless of the market's behavior. So that's why this episode is really important.
I agree, and I actually think this is going to be one of the best years. As an investor, I think this is the time to get in on these infrastructure plays and to buy in, because 100%. You don't have to chase the bull market, like you said. And yeah, I don't know of many investors that make money chasing bull market rallies, right? This is the time, and this stuff's happening now. So, dude, I'm excited to have you here. Great perspective. Should we kick this off?
Let's kick off.
Yeah. So first slide, and you know, we just already talked about this, but you know, passive income strategies for this sideways and bear market, like most people won't know what that means. So what does that mean?
It's a really good question. A lot of people, when they're thinking about passive income, they kind of measure things on a risk reward perspective, right? So a lot of people think, okay, it's low risk, so it's definitely a low reward, it's high risk, it's high reward. But today, Brian, we want to have something that's asymmetrical. What does asymmetrical risk return mean? That means that even if we're taking low risk, we could have medium rewards, or low risk, we could have high rewards. And the asymmetrical plays are really those that build wealth over time. And passive income, as you know, is just minimum effort, your money works for itself. And yeah, simply that.
Yeah, and I know, but I think a lot of people are conditioned that passive income is super passive, like you said, and super low return.
That's true.
But like crypto is all about this concept of asymmetric risk, which means you can have much more upside than downside, which you can't traditionally get with investments. When you buy a share of Apple stock, you know, there's a lot of times equal upside and downside. Same with like real estate, same with like a lot of traditional investments like bonds. But in crypto, there is more upside. And so some of the things we're going to talk about today is kind of next level stuff. So yeah, I'm going to keep these slides rolling. You've got another thing that talks about this kind of risk return. And I guess what you're trying to do is this minimize risk, maximize returns. What is that thinking, you know, behind that?
So I think for today, Brian, because we're in a bearish market, or we were in a bear market, and a lot of these infrastructural plays, the L1s, the blockchains, have already retraced so much based on Fibonacci levels that we don't need to focus on the degen, crazy high risk, crazy high returns. There's so many low risk plays that are asymmetrical that today we're not going to focus on triple digit APY, simply because there's so many low hanging fruits at the moment in this bearish market, or in this corrected market, let's say.
Yeah, and this is good. And this is a point that I think everyone's going to feel throughout this episode, because look, there's a lot of speculative cryptos that can get great returns. There's a lot of things that have, like you said, triple digit APYs. But look back to Warren Buffett. Look back to basic portfolio theory, is that you have a small amount of your investments in high risk stuff. You have the bulk of your investments in lower risk stuff. So your money's there next year and the year after and the year after. So what we're going to talk about today, I think, is talking about some of those, like, you know, the places you probably put more of your portfolio in that have great returns, but like you said, lower risk. And a lot of people don't even know this stuff exists in crypto, because they're so used to, oh, the coin did this, or these high yield pieces, but there's some exciting stuff happening. I think we're going to bounce next to this slide, which is, you're going to explain better, but it really has this graph of risk versus reward, XY axis. What do we see happening here, and how do you explain this to people?
So this is not perfect, because there are many components in DeFi, and it's kind of general, stereotypical, but it's a good base to start with, I think. But generally speaking, if we look at risk rewards, or more specifically on the risk side, proof of stake and the crowd loans, which you talked about in the previous episode, which was awesome. I love the vibe we had there as well. It was so great. A lot of fun. The protocol and the proof of stake is probably the lowest risk amongst all ways to stake. And the reason behind that is, even when some of the blockchains crashed, which we had with Solana, you know, in the past months, you still get your returns. It's very unlikely, very, very, very unlikely, and unless the blockchain breaks, as you mentioned earlier. We'll talk about the risk later, but that's probably the lowest risk when it comes to earning an APY. And then obviously, then you have the AAA, you know, protocols like we see here, Aave, we see Compound, and these are single coin staking pools. So it's just lending on DeFi. So once again, quite low risk relative to other potential plays. So we had proof of stake first. We have single coin staking, lending second, and then we're starting to go and play with AMM pools, right? And automated market makers. And there's a little bit more risk, as you know, in permanent loss, because you're going to have to pair them up with a stablecoin maybe and a non-stable, or you can choose and play around with that. But there's market risk and impermanent loss risk. And then the high risk are those where you're using multiple protocols, you're sending the LP tokens to another platform, to another strategy. And the more layering you have, the more risk you're taking. But of course, you can make triple digit, quadruple digit APY, but it doesn't sustain.
Yeah, and that's well said. And this is what SwissBorg does every day. I mean, you guys have a lot of money that you're moving around, so you understand deeply these protocols, the different risk levels. You offer them to your clients and your users. So you understand this quite well.
We had up to $2 billion of assets under management. So yeah, we do understand
$2 billion,
it quite well.
Right? Okay. Yeah, and this is some of the stuff we teach in the DeFi Academy, and we get our students to start looking at these things. I actually get all of my students to, well, first of all, earn yield on their crypto, usually through Aave on this very low risk. So they get a little yield on Ethereum just to understand how a protocol works. Then I actually get them to do a liquidity pool so they understand what it's like to maybe experience impermanent loss. And like that's about as far as we try to push their brain power, but they start to see, okay, I can get maybe a little more return there, but there's risk and it also gets a little more complicated. I think what we're going to probably do is have you back to talk a bit more about the automated market making, because that'll be probably a separate episode. But it just, like you said, if you want to push out the risk appetite, you can get a little more rewards. But I think there's some amazing low-hanging fruit, as you would like to say, Alex, that we're going to cover today, where people will be like, oh my gosh, I didn't realize I could get this maximum yield right now and not have to be subject to market movements. And basically, like you said, unless the blockchain breaks, that yield is going to continue to be paid to you over time. So it is a lower risk. And I'm glad you pointed out some of these risks, because there is counterparty risk out there. There is impermanent loss risks with some of these things. It's not always talked about.
It's not always talked about. And also the medium and higher risk also involve more effort. Because we always think about things in risk return, but we forget about all the effort, all the active work versus real passive work, right?
Yeah, and we'll see that today as Alex goes into the proof of staking. I mean, it's kind of a set it and forget it type of thing, whereas when you get the AMM pools, it does get really complicated. There's more risk, you have to manage it, you have to think about it. I always tell my students, like, I don't want you thinking about crypto 24/7. I want you worried about your business and your family life and your body and your mind. You shouldn't be thinking and stressed about crypto all the time. Otherwise, you're not really getting a return if you're spending 6 hours a day on it. So great point. And we're going to show a lot of these things. And I know you guys also allow plug and play stuff on SwissBorg to where you handle a lot of that. So, I want to talk about that too. We should probably zoom out real quick, because we've been talking a lot about crypto, and maybe frame what we're about to talk about in comparison to what I used to do as a banker, right?
Yes.
I think this next slide that you put up that looks like a superhero slide. What are you trying to say here with this slide here?
Looks like the boxing fight slide.
Yeah, right?
But essentially, so today we'll talk about the low risks. So we're talking about proof of stake and single coin staking, specifically for stables, because we see so much asymmetrical returns here. But I think going back to the traditional TradFi route would make a lot of sense for people who have the same background as you and maybe are not just moving into DeFi at the moment. What is the difference between proof of stake and the normal shares or equity plays that we see in traditional finance? And I think one of the cool things of seeing this, Brian, in terms of proof of stake is, you know how in traditional finance you have common shares and preferred shares, or common stocks and preferred stocks?
Yeah. It's something that when you go to buy a company, you can go back in the day in the Wall Street Journal and you could say, okay, I could buy common stock, basically shares of Apple Computer, or you could buy or Ford Motor Company or Disney, or you could buy the preferred shares, right? Which meant you got a fixed yield over time.
Yes.
Right? And that was an option that you got. You could kind of have one or the other. You could get the upside of the share and get no promised dividend, or you could get a little bit more of a fixed dividend and maybe slightly less ownership in the company.
Exactly it. And you'd get voting rights on the common shares as well. Right. But the beauty about proof of stake, just to show why proof of stake and this kind of similar to an equity model, right? Because you need to hold the tokens. But what's better about DeFi than TradFi is you have all of that in one. So the validators, those who run the nodes, they're getting voting rights plus the dividends in one deal.
Right, plus the upside of the tokens.
Plus the upside of the tokens.
And the tokens can mean, it can be a demand because they're being used for transactions, or they're the total, market cap of that protocol. So again, look at something like Ethereum, the second biggest. You need ETH to pay for gas. The ETH also goes up in value over time. And so a little bit different than like a share of Ford Motor Company. If you stake it, you get, like you said, voting rights, potentially some really interesting yields, and the upside of the protocol.
And on top of that, you don't need those silly quarterly reports. Everything is live on chain in real time. Yeah. So you don't need those reports. You can track it right now.
And it's in a smart contract too, which I think you maybe touch on later, which like you said, you can see, it's programmed, it's trackable. It's something we didn't always see with TradFi.
Exactly. And one thing that's important for those staking, on proof of stake, the beauty of this, and again, it's kind of, for the lack of a better analogy, it's like owning a stock and delegating that stock to those with the preferred and common shares and reaping benefits from delegating your stock, which you can't do in traditional finance.
Yeah, that's a really good example. All right, and so again, if anybody's watching us that doesn't own crypto, again, the best way to do this is to start, buying a small amount of crypto, $50 or $100, and then try it, and you can start to see comparisons with buying a stock or some of your traditional investments. And if you're one of those people that says, I don't buy stocks, well, trust me, some of your pension money is locked up in a stock portfolio somewhere. Some of your IRA money, you actually are exposed to the stock markets. So again, look at all the global events recently. You want to be involved in this asset class. So go buy something small. And now we're basically going to show you what to do with it. Before we get into the blockchains, I think it's good to show that, something that you guys provide at SwissBorg and that people can get in a lot of different ways is basically yields, right? On their euros, on their dollars, on their tokens, and also on their stable coins. And that's something that you guys provide a bit, like an online bank, but like you said, it's kind of got a smart contract based on it. It's trackable, and obviously it's got asymmetric yield. So like, what are we looking at here? Is this like what you guys provide for like dollars and other instruments?
Exactly. So right now we're offering DeFi yields, but pretty soon we'll have proof of stake as well. So if you don't want to do this manually, if you want it automated, compounded by itself, doing nothing else than that and not even looking at the app, soon you'll be able to do it with us.
Which is pretty cool, because right now, if you want to do the staking, it's technically challenging. Let's be honest. Like, you have to go out there. Sometimes you have to have a large enough piece to get a node, and it's complicated. So again, you could get those asymmetric yields and have someone else do the hard work.
Exactly.
So that's coming soon, potentially,
yes,
on SwissBorg. Okay. All right, cool. All right, let's jump into this and let's talk about proof of stake yields. I think you have a slide that talks about top 10 market caps, right? So let's look at these, because a lot of people will know these names.
Absolutely. So I think really the first question to ask ourselves before joining proof of stake is which protocol, right? It's the very simple question. Should I do Ethereum 2.0? Should I do Solana? Why not? I think today our goal, Brian, is to make this as easy as possible and as actionable as possible for everyone to really understand what should I look for and which one should I choose, right? Yeah. For those who are just uncomfortable, they can just, diversify their proof of stake through multiple protocols. These are all top 20 market cap, so they're proven, they have large communities, they're not going to go to zero tomorrow, so we're trying to keep it as safe as possible, the top 20 CMC.
Right, and keep it general, so probably everybody watching this might have some of these coins, and they probably aren't actually staking them right now. So this is a great way, probably anybody can take action and get some staking yield. Even if you're new, you could literally get $100 worth of one of these and try to take some action on the back of it.
Exactly.
Quick question right away is, I don't see Bitcoin here. Why is that? Do we need to address that elephant that's hanging out in the room? Why Bitcoin isn't on here? Because a lot of people will know that currency and say, why can't I stake Bitcoin?
Yeah, because Bitcoin is proof of work, so it's a bit more complicated in terms of machinery. Proof of stake is a bit easier, maybe not as robust as proof of work, and the chains don't really need a proof of work system. But yeah, we're only focusing on proof of stake.
Yeah, and like that is the future, and all of these layer ones and all the new technology are moving to proof of stake because it's faster, it's cheaper, it's better for the environment. And so it's here to stay. We will see, well, Bitcoin never will by design. We will see if Ethereum ever makes the move to proof of stake, and it might not. But in the meantime, there's plenty of amazing layer one protocols and others, including SwissBorg, where you can stake these coins. And like you said, transfer some of those voting rights, get yield, get the upside in the protocol as well. And that's what we're going to kind of talk about today.
Absolutely.
Perfect.
Should I have a look at the blockchain?
Yeah, let's do this. So we're bounced to the next slide, right?
Yeah.
Okay, explain this. What is this?
So which blockchain should I choose, right? So here we have a little bit of a list, and basically 5 criteria if you're new to this. The first one, in order to really choose, okay, which blockchain, should I go for Avalanche, should I go for ETH, should I go for Solana? Number one is simply to use the chain, right? If you want to buy McDonald's stock, go and eat the burgers, go to another chain, make sure that the quality is consistent, make sure their parking lots are filled, you know what I mean?
Right.
So just trying the chain, because I think, Brian, in terms of user experience, in terms of UI, in terms of speed, in terms of costs, there's so many things that we can discover by just using the chain that we won't by reading a website or a white paper.
Man, it feels like Warren Buffett. Like Warren Buffett, you know, he goes and eat at McDonald's, he'll get the Hanes underwear, he'll go to Disney, he'll drink the Coca-Cola, and again, he bets on things that he believes in. And again, last time you were here, you said, you know, again, when you look at a protocol, go test the technology yourself.
Yeah.
And I'd say most people in the crypto think, oh, I'm not smart enough to evaluate a protocol, but you are, right? Go on there, see if it works. Right?
Exactly.
See if the dApp plugs in. See if that happens. So go in there and you say kick the tires around and make sure you're happy with the protocol more than anything.
Absolutely.
Yeah.
And then all the rest is just supplemental, but also critical. You know, you want to look at the white paper because you want to see if the technology is scalable. The governance, is it decentralized? The on-chain statistics, you get tons of websites with on-chain statistics that replace the whole shareholder report because it's live and in real time. Websites, socials, community chats, et cetera, et cetera. And the community is really important as well, right? I know some people who are hardcore Cosmos fans because the community welcomed them with open arms. They're really supportive. They invite you to events. They go out, they build friends, right? Yeah. So a lot of these things are just maybe 5 simple criteria on how you can already start understanding which chain I want to support.
This stuff's so important, and last time you were here, we talked about this. We're going to put a link below, and it's the Polkadot Parachain auction piece, but we went deep on, you know, the 5 T's, and, you know, one of them was technology and traction, and again, you'd be amazed within 10 minutes what you could discover by going on the social platforms, going to Discord, seeing what the community's doing, plug in the technology yourself, scan the white paper. I make all my students read the original Bitcoin white paper.
Oh, it's
and not, I know they're going to start to get confused on page 6, but I'm like, at least you know what it looks like.
Yeah.
And now you've read it. Just like you should read your car insurance form when you rent a car. You should scan through it. You'd be amazed what you can pick up, right? So this stuff is why blockchain is so exciting, because if this was a stock that you had to buy for the first time, you could never get this information on it, could you? And community is really important as well. So, all right, this is really important for people to do and understand. And like you said, there's top 10 protocols we're showing here. You can go kick the tires and find one you're comfortable with, right?
Absolutely. And I think 2 pieces of information that are critical in this particular chart is if we look at, for example, Solana, right? We look at that row in particular, you can see the reward size, you can see also the market cap, and how much of the tokens are staked. For instance, Solana, 75% of tokens staked is a very bullish metric, right? You're like 3/4 of all the tokens that exist, people are staking them because they believe in it long term. So that's a good metric. But then Solana, in terms of the actual market cap, it is $32 billion, while you can have something like Polkadot that's only $20 billion. And Polkadot still has, you know, more than half of the tokens staked, the DOT, and you have twice the return, the APY, than you have with Sol, right? Yeah. So do you think Polkadot is undervalued? And plus you're getting double the APY. Is that a good play or not? For me, it is, for instance, because I believe in Polkadot, the technology, the governance. We talked about the parachain, which is beautiful in itself. And then you can see other different metrics. These are just some basic metrics, Brian, that people can look at and already make them realize, okay, this is very bullish. There's a lot staked. Wait, this market cap is a bit high relative to Ethereum or a bit low relative to Ethereum. And you can look at the rewards. So those are the key 3 metrics that people can look at here.
Yeah, this is really important, and they're probably, well, they're not ranked by market cap, but these are big chunky market caps too. So I would just say to everybody, you know, you're seeing these market caps, they're all, you know, above 10 billion. So again, we're all talking about the big high protocols, which means by definition, they've got a lot of users, a lot of adoption. But then thanks to on-chain metrics, we can see, like you said, total amount staked. which means you're doing something a lot of other people are doing who really believe in this protocol long term. They believe that staking is clearly the right idea because they're doing it. So there's a lot of information you can get here, and then you can weigh it up and choose the one that you like, right? And this is a good way to start, and keep it simple. And like you said, start in the top 20, right?
Absolutely. So both you love, but also trust. You know, both the heart and the brains are connected here.
Yeah. Okay. Really powerful stuff. And again, I'd say to everybody out there, you don't have to trust an analyst. This is why Wall Street used to be different. Like in Wall Street, you'd have to trust the Morgan Stanley analyst to buy the .com share, and that no one would ever presume that you're smart enough to make a decision. You know, Web 3.0 is different. It empowers the users. And I would say most people out there, they can get a feel for this, right? They can plug in, they can look at the community, they can follow them on Discord, they can listen to Gavin Woods talk, they can listen to those people talk, and they can be like, okay, I like this. I'm going to be on this. Maybe they bought an NFT on Solana. They're like, okay, I feel comfortable with this. And I think that's a really important thing to do. Trust your gut, do your own research, right?
100%, my friend. Should we dig deeper?
Yeah, let's go. Let's go. This next slide looks hot.
Okay, so let's try to give more specifications to the people watching out there so that they really have a better idea on what are the criteria that they need in order to pick the right chain, right, for proof of stake. So here, guys, on the left-hand side, you can see on the vertical axis, we first have return rates, right? So how much can I earn relative to how much I stake, right? So for instance, across these top 20 blockchain protocols in proof of stake, you guys can see that Cosmos is juicy, man. 14 to 15% APY for a low risk protocol that's already corrected probably more than 50% is a pretty decent type of yield if you believe in the ecosystem. It requires more due diligence, not financial advice. But
yes, yes, of course we're not. But yeah, that really sticks out. And for people that maybe haven't been investing for a long time, I mean, to get a double-digit, fixed return on a protocol you believe in, it doesn't come around very often. I'm not comparing it to like a U.S. Treasury bond, but like I think a 10-year Treasury bond is like a 1% yield. So, that Cosmos sticks out, Polkadot sticks out as well as double digits. And then you kind of see the rest that are single digit, which are still healthy returns, right? Healthy returns, it's a fixed return. Again, you tell most people over 20 years if I can give you a 7% return or a 10% return. I mean, that's a massive return. That means you're doubling your money every, 6, 7 years compounded. That's something it's almost unheard of on Wall Street. So, these are pretty good, juicy yields. And again, in a bear market, I think a lot of people are waking up and saying, oh, I'm not going to make 50% every month on my coins. This is where you want to put maybe that less risky asset for a longer period of time.
And just for everyone watching out there, and this is a personal thing, I'm not saying it's the best thing to do, so I'm definitely not a professional or the perfect mind for this, but right now, Brian, in the bearish markets and sluggish markets, I'm not buying a single coin or token that doesn't have yield. I'm just not interested. Because when we're in a bear market, we're buying low, plus we're earning that APY. We're actually compounding this, as you mentioned earlier. You're multiplying this, right? So we see 14, 15% for Cosmos, but it's retraced more than 50%, for instance. If it goes back to the initial all-time high, that's already 2xing the APY, right? And that compounds on top of that. It's not just 30% APY, that actually increases that fold. So that's why I think these are asymmetrical plays.
And you don't buy a single coin in the bear market unless there's yield.
Not a single one.
Interesting, because you're just saying, I can be choosy and it's got to have something else. It's got to bring me yield to the table because I know in the long run, that's how I'm probably going to get paid.
Exactly. And this show is all about making money regardless of the market conditions.
Man, it sounds very Warren Buffett. It sounds like something a long-term strategic investor would do. Like get something with some yield to it. All right, and so we see some other examples like Cardano and Ethereum at like 4%, 5%, Polygon's at 9%. So again, people will choose their risk reward, right? Because it's important. Cosmos is 3x the return of Ethereum. And again, you need to just judge and say, okay, do I think it's 3 times as risky? If I don't, then this looks interesting to me.
Exactly. So if you combine the previous slide and this slide, Brian, it already paints the nice picture, like the first picture that you want to see. And then the second category in the vertical axis is platforms. So this is just where I can do it, Brian. We don't need to cover that in detail. But if they're wondering all of a sudden, oh, I want to use Polkadot, I want to do proof of stake on Polkadot, you can use a JS extension. If you want to use Cardano, you can use the Yoroi wallet. If you want to use Solana, Phantom, and Soulflare are the 2 best. For Cosmos, Kepler is a desktop and Cosmos Station is a mobile app.
Okay.
So it's just where you do it.
Nice, that's helpful. And we used the Polkadot.js extension to do the parachain auctions last time. And yeah, a lot of people might be familiar with some of these wallets, Phantom obviously for Solana and stuff. So good to know. So that's how people can get in touch with them. What else is interesting to call out here?
We could do very quickly, the third category is validator commission. So remember, it's just like giving a stock to someone who owns preferred or common shares. The commission I would highly recommend in average is never go for someone more than 10%. 10% is kind of like the industry standard. If you see some of these validators like 20, 30, 40%, I don't even touch it. As a matter of fact, we'll look at a slide later, but there's an option on Polkadot where you can just click something. I don't want to see any of the validator nodes that charge more than 20% commission.
Okay, all right. So finally, a little piece there. And then obviously the minimum becomes interesting. But again, I guess that's what you guys are trying to solve with SwissBorg, where you can kind of pool things and get through the minimums and pass that on to the users, right?
Exactly.
All right. Okay, really good stuff. All right, let's keep it moving, man. We're on a good pace here. This next slide, it talks about the risks, right? So what do we need to know about these proof of stake risks?
All right. So despite the fact that it's a very low risk play, there's still risks involved. So we want to make sure everyone knows that. And the number one risk is the protocol risk, which means that if the blockchain breaks in a black swan event or whatever, the token goes to zero. But if you're staking or not, the token will still go to zero.
Right.
So is it really a risk? And we see like some blockchains that have downtime for a certain period of time, which is kind of connecting to slashing, which we'll look at next. But you will not earn yields when the blockchains have that downtime because no transactions are happening. So that's a bit of the protocol risk, either go to zero or either downtime.
Okay, and we've seen some protocols go down for 24 hours, some big ones as well, and come back. And I think it's important. At the end of the day, this is all technology. It's actually proven to be pretty damn robust all around. But it is a risk, and you should be aware of it. But you should also know that if you're owning it, you're also taking that risk. Exactly. So it's like owning an asset. Do you want yield on that asset while you're owning that asset? Either way, you are subject to prices of the asset.
Absolutely.
Okay.
And the most important risk, so this is something that people really need to be careful with, is the malicious validator, right? So are you going to give your stocks or your tokens to someone who does malicious things and ends up losing your actual tokens? But there are many ways to avoid this, right? If there's a malicious actor. If we can look at the actual screenshot here, just below this. I took the example of Polkadot because I think Polkadot's proof of stake is a lot more advanced in terms of information than any other of the chains that I've used so far, and I've used them all. And what you can see here is, number one, if we look at on the left side where we have the validator names, you can see that green circle, right? That little chain.
Yeah.
Those are people who have done some sort of KYC. So they provided the link to the URL to their website, to their email addresses. So it's already like a KYC proof of you're not just this random guy who's coming on our chain.
Okay. All right. So you have to evaluate kind of each validator. And then this is a way of kind of doing your 5 T's on a validator. And you can see.
Absolutely. Yeah. So you have to look at that. And then there's another one on the, if you see the little icons on the top of this, you have oversubscribed.
Yeah.
So oversubscribe means they can't take your money. So you don't want to delegate your tokens to them. And then one thing that's really important here, Brian, so if I'm looking at the validators here, which one is the sexy one, right? So we already know that the first two, they have that red icon, that Bordeaux maroon icon, which means they're oversubscribed. So we're not going to use them. However, I really like Cypher Labs because Cypher Labs are not oversubscribed. Their identity is verified. And on top of that, they have 5,000 DOT staked already of their own stake. So they have skin in the game. So here, again, we need to look a little more deep into this, and the commission's only 3%. So that, just to do it very roughly, actually I go deeper than that, but just to give a rough idea to choose the right validator to avoid the malicious guy.
This is interesting. I guess this is why you also might want someone to be helping you with this, right? Because it's more things for an individual to have to look through, do due diligence on, because you are passing those tokens to someone else at the end of the day.
Exactly.
Right, but you got the on-chain metrics and you can see a lot with it, right?
And there's some good websites, stakingrewards.com.
To continue watching the rest of the episode for free, visit our website londonreal.tv or click the link in the description below.